Welcome to Real Estate Milestones, where we explore fascinating topics in commercial real estate with knowledgeable industry experts. I'm your host, Ben Malik, and I'm a young real estate professional who is passionate about adding value to people's lives through the incredible power of real estate. My goal is to help you discover what the heck is going on in the industry and how you can get involved. This is Real Estate Milestones, where your future in real estate lies just around the corner.
Hello, everybody. Welcome back to Real Estate Milestones. Today we have a very special guest. We have Brian Burke, who's the author of The Hands-Off Investor, an insider's guide to investing in passive real estate syndications, which is a great book that I've been reading and have also shared with my family and friends. Definitely recommend it. He's the president and CEO of Praxis Capital, vertically integrated real estate private equity firm founded in 2001 with having acquired over $800 million of multifamily, and that's 4,000 units and 750 single family homes. So got a lot of experience, 30 years of experience, and I'm excited to learn from Brian. So Brian, thanks for coming on the show today.
Thanks for having me here, Ben. This is going to be fun.
Absolutely. So to start it off, can you tell us about your first milestone in real estate and maybe a little bit how we got there? And yeah.
My first milestone in real estate was really getting my first deal. And, I was like 20 years old. I was not too far out of high school. I didn't know anything. I didn't know anyone. I didn't have any money. But I found a property I wanted to buy, and the seller was willing to carry back the down payment. So I found a finance company that would finance the bulk of the purchase price, and I found a seller who would carry back the down payment. So I was able to buy that property with no money down, which was a great fit because I had no money. So there was really no other option. It was either buy with no money or don't buy at all. So that was my first milestone, was just getting that first deal under my belt.
And what was that deal? Was it a single family?
Single family. Yeah, it was single family, and I bought it to rent it out. And I did, and sold it a couple of years later, and I don't even know if I made any money on it. I think I got probably more experience than I did profit out of it, frankly.
Yeah, well, it makes a lot of sense. I guess going from there, how did was real estate always your full-time job, or how did you kind of get into, being I guess an entrepreneur in real estate?
Well, when I bought that first investment, I was a checkout clerk at a grocery store, and I was making like $13 an hour. And so, again, I didn't have any money, right? No savings, no nothing. But I always wanted to be a real estate investor. And, that was kind of my first foray into doing it. And then, I had to make a living, and I wasn't making good money at the grocery store. And it's going to take a while for my real estate business to build up. So I went into law enforcement, and I worked at a local public safety department, which was like a combined police and fire department. And, kind of worked my way up through the ranks at that department on both the police side and the fire side, which gave me a lot of life experience and seeing crisis and turmoil. And, the only time anybody would ever call me is if it was their worst day of their life. So, you get to see a lot of things and do a lot of things. And at the same time, I was also kind of working nights and weekends because I was on swing shift with Monday, Tuesday, Wednesday off. So I had almost the whole business week available, and I would use that business week to go out and try to buy real estate investments and find properties to buy and houses to flip. And it was a grind. I mean, it took a long time to do it, and it took a long time to figure out how to finance it. But I was working for a paycheck the whole time I was getting started in this business.
Yeah, that's a interesting way in. I mean, it's just funny that I always learn how many different ways there is to get into real estate. So I mean, no one should be discouraged for sure. So I guess from there you started to, I guess you did a lot of single family fix and flips. At some point realized that you wanted to do bigger assets. I guess kind of you describe your motivation and how you got started with I guess investing in bigger assets.
Yeah, my first introduction to this was after I'd probably done a few dozen flips, maybe even as many as 100. And I had bought a few houses that I kept, and I thought, well, I'll hold on to one every once in a while. I'll just keep one as a rental. And so I did that. And after a while, they had gone up in value a little bit. And I realized, like, I could sell these, do a tax deferred exchange, and buy an apartment building, because that's what monopoly is, right? You trade 4 houses for a hotel. Well, that's what I thought I would do. So I sold the 2 houses, and I bought a 16 unit apartment building. And that was my first multifamily purchase. That was 21 years ago. And I thought, this is a great way to like earn passive income while I'm doing all these house flips. It's like house flips are cool, but if you stop doing it, then all of a sudden now you're not making anything. So I thought if I could buy income property, then even if I stopped flipping houses, I could still have income from the income property. At least that was my theory. It didn't quite work out the way I thought, but that was my theory.
And so what ended up happening that it wasn't the way you thought?
Reality happened, and the reality of income property is they don't produce a lot of income unless you have a lot of it, and I mean a lot. The 16 unit apartment building isn't going to allow you to retire off of the income, especially when you got a loan to pay and maintenance and upgrades and capital expenditures and all that stuff. It eats up a lot of the profits. So you're lucky if you make a little bit here and there, and that's what I learned early on, that rental property ownership is a grind, and you've got to be able to accumulate a pretty sizable portfolio if you want to live off the income. And I just found that really wasn't going to be the best route for me. So I kept buying income property just because I wanted to build a base of assets and actually gain wealth, because there was a difference between like getting income to be able to quit my job and building wealth. So that became less of an income strategy and more of a wealth building strategy. And then I went back, to house. Well, I didn't really go back to house flipping. I never really stopped. But house flipping was my primary source of income for a while, until around middle of the 2000s decade, right around 2005, 6. The market was just so crazy. I'm like, I got to stop, because there's going to be some massive chaos that's about to happen. So I really kind of pulled back and just focused on my commercial investments, and the whole real estate market collapsed. And when the real estate market collapsed, it was on one hand very challenging, but on the other hand, it was extraordinarily exciting, because it's like now I can finally buy a lot of deals. And that's when my business just totally blew up. I went from doing a dozen house flips a year to doing over 100 house flips a year. And we were doing really, really, really well. So it was pretty fascinating times, and just taking advantage of what the market was presenting us.
Yeah, so I want to get a little bit deeper into that, because there's a lot of people in real estate who have not lived through 2008. I happen to have not. I'm only 21, but I'm really fascinated with what went on there. Maybe or maybe not. There's some similarities with what's going on now. We can get to that. But can you tell us a little bit about your experience in 2008? I guess, did you have any, I guess, was there any bad things that were happening to you personally, and I guess lessons to come from that? But obviously I would love to hear about the opportunity that also came out of it.
Yeah, I mean, it was a mixed bag. It was kind of weird because, like, on the bad side, I had bought a 60 unit apartment building in 2008. And by 2009, the bottom fell out of the economy. I mean, Lehman Brothers collapsed, Bear Stearns collapsed. I mean, the whole banking system was imploding, and it was just all kinds of chaos. That resulted in an economic downturn that resulted in mass layoffs, people losing their jobs, and income cuts to income, that sort of thing. So my apartment building was like, I used to joke that half the units were empty and the other half weren't paying. And that was kind of how it was, actually. And it got so bad at one point that the rental income from the property was only just enough to cover the expenses. I could pay the insurance, the property taxes, the management fees, repairs, utilities, but there was $0 left over to pay for the loan, the debt service. And that was $15,000 a month. Well, I was also fortunate that the house flipping business was going crazy. And so we were buying and fixing and flipping and making a lot of money. So I was able to actually pay that $15,000 a month payment out of my very own pocket from the money I was making from my house flips, so that I could salvage that deal and make sure my investors didn't lose any money. So on one hand, it was painful, but on the other hand, it was profitable. So it was a weird time for me, because there were ups and downs. It was a bit of an emotional roller coaster.
Yeah, absolutely. And I guess you started to touch on a big theme from your book, that the sponsor is the most important part of the deal. It sounds like you were a good steward of your investors' capital, that obviously if you're here for the long run, I'm sure even though it was a tough time, people who were invested with other sponsors who weren't as I guess considerate or as long-term thinking as you probably, decided, you're the guy, and the other ones who might not be as prudent would not be as good to invest with. But I guess I want to touch on that theme, like in terms of the importance of investing with a good sponsor, and kind of would love to, hear you tell us a little bit about your thoughts on that.
Yeah, at the time, a lot of people were walking away from deals and handing the keys back to the bank and letting them foreclose and that sort of stuff. And, the whole time, of course, I'm thinking in the back of my mind, like, this is stupid. I'm cutting these $15,000 a month checks, throwing good money after bad. What's the end game here? But on the other side, I knew that if I default on this loan, I'm going to ruin my credit. I'm going to ruin my ability to get loans on future properties. I'm going to ruin my relationships with investors. They're going to tell everybody they know. And it was kind of funny, about 5 years after this all started, everything had kind of come back around, right? The economy was better, incomes were better, rents were up and all this stuff. And the property was cash flowing and paying the debt on its own. The value had gone up, and I sold the property. And it was kind of fun to call up the investors and be like, hey, I'm just wanted to give you a heads up. I'm about to send you a check. And they're like, send me a check for what? It's like, all your money back plus the profit that you made. And they're like, oh, I wrote that investment off years ago. I didn't even think we were ever going to see that money. And it's like, don't ever give up when I'm at the helm. So it was really fun to be able to do that. And now, I can tell investors, new investors, why should I invest with you? Well, we've been doing this for, with investor money for 22 years, and we've never lost a dime of investor principal. Now, had I walked away during those times, I would not be able to say that. And those words are valuable, and it means a lot. And it's really been very helpful for our growth. And we wouldn't be where we are today if it wasn't for the decisions that I made, back then 15 years ago.
Yeah, that's really powerful in terms of the long-term thinking. And if you're going to be in the business for long term, you ought to, think like that. So coming to 2023, if I'm not mistaken, I remember on a panel, I guess last June in 2022, you mentioned that you had been selling a lot of your assets. I kind of wanted to hear if that, first of all, if I'm remembering correctly, and also how, now that we're in 2023, if you were happy with that you made a decision, kind of what was the motivation, and then guess what's your thoughts now about your portfolio?
Yeah, you do recall that correctly. I sold 3/4 of my portfolio in 2021 and the first half of 2022, and it was the best decision I've ever made. We basically sold at the top of the market, and we did really, really well. And had we not sold, all of those properties that we did sell would have been worth a lot less than they were then. So they'd be worth a lot less now than they were then. So we managed to bank some really good results for our investors, which we would have missed out on if we didn't take that opportunity. So yes, we did, and I'm very glad.
So obviously you had been in the industry for a long time and experienced a lot of growth, and probably seen, more growth than people who started in 2018. And maybe that's part of your motivation. But I want to, what was your motivation for selling? And, I guess it's worked out, but, yeah, so I'm curious.
I've seen this movie before. I know how this works. I could tell just by things I was seeing that the market was overheated and was probably going to suffer some challenges. And I didn't want to suffer them along with everybody else. I wanted to avoid that to the best extent I could. And some of the signals I was seeing was when we were trying to buy stuff, there would be 20 offers on everything that we wanted to buy. And probably 10 of those offers were from buyers that didn't know what they were doing. And at least 5 or 6 of those offers had non-refundable deposits, sometimes 7 figures of non-refundable deposits at the signing of the contract, at prices that were way above what we were willing to pay. And I figured if people are willing to pay prices like that with terms like that, why shouldn't we sell everything we own to them? And then after this blows up in their face, we can come back later and we can pick stuff back up at much lower prices. And, and I think history will show once this is fully played out, that's exactly what we'll have done.
And so that brings me to my next question. What is your outlook right now where we are about getting back into the market, finding opportunities, just your thoughts in general?
I think we're not ready yet. I think the market still has more downward risk that hasn't fully played out. And I think we're giving it more time. We went completely pencils down on analyzing new acquisition opportunities in early 2022. And we stayed that way until probably a couple of months ago when we picked our pencils up, but we're not writing anything with it. We're looking at deals, we're underwriting, we're doing some financial analysis, but we're not seriously assuming that we're going to get any of these deals. It's just too early. There's a little bit more downside left to run, in my opinion, but we do want to stay very close to the market. We want to be able to see the signals of when that may turn around in our favor, where buying will make a lot of sense. And if we're not involved in the market, it'll sail right by and we'll totally miss it. So we've got our finger on the button, but we're not pushing it.
So what's the signals what are some of the signals that you're looking for?
Some of it's kinetic. I mean, it's you just kind of know it when you see it. When we see fewer offers coming in on properties that are offered for sale or no offers, when we see more sellers coming to market, when we start hearing about more sellers that are in foreclosure or having difficulty, running into problems or whatever the case may be. When you start to see a confluence of all those things coming together at the same time, you're getting close.
Absolutely. And so I want to touch on a thing that I think you probably have some good perspectives on. What's your opinion on floating versus fixed rate debt? I guess that opinion may have evolved over the years, especially given where we are now. But, it seems like floating rate debt has burnt or is going to burn a bunch of people. Does that mean we should be looking at fixed rate or is floating rate still come with the advantages that you're, excited about?
Yeah, I think floating rate debt almost always has an advantage over fixed rate debt. There's a few exceptions to that, and we've just witnessed one. And of course, when you just witness the exception to the rule, you think it's the new rule, but it's not. It's still the exception. The floating rate debt that really has been most crushing has been floating rate bridge debt. And this is debt that has a short-term maturity. These are loans that are intended to be used for repositioning opportunities where you're going to come in, buy an underperforming property, fix it up, manage it better, turn it around and resell it, or refinance it. That's the play. The problem is because there's a little bit more risk, they tend to come with a little bit higher interest rate than floating rate debt from, say, Freddie Mac or Fannie Mae. Our strategy has always been to borrow floating rate debt from Freddie Mac or Fannie Mae with a 10-year maturity. But the bridge debt has a tendency to have a 3-year maturity, sometimes with 2 1-year extension options. But where people are getting caught is the rate started out higher than agency debt to begin with. The interest rate caps are higher, meaning now that maybe they started at 4.5% or 5.5%, but now they're at 8.5% or 9.5%. Whereas our floating rate debt started at 3.5% and is now at 6.5%, but capped at 5%. Theirs might be capped at 7 or 8, so it's a lot more expensive. But the 3 years is going to come due pretty soon, and it's amazing how fast 3 years go. You're in college, like next thing you know, bam, you went from just getting into preparing for your graduation. It goes by fast, and the problem is that if the market turns against you in that short 3-year window, you can get caught, and now you've got to pay this loan off, and you can't sell because prices have gone down. You can't refinance because rates are higher, and the sizing of loans that you could get isn't enough to pay off the existing loan. So people get stuck and they end up having to sell at a loss. That's where it gets crushing. The type of floating rate debt that we've used with the agency floating rate debt, with a 10-year maturity, I can ride out. Our loan to value ratios are very low. I believe in leveraging modestly. And so our loan to value ratios are low enough that the debt service doesn't kill us. It impacts distributions, to be sure, but it doesn't crush us the way bridge debt would. And we don't have the maturity hanging over our head. We have 6, 7, 8, 9 years still left to be able to refinance or sell. And by then, I think we'll see much different conditions than we're seeing today.
Yeah, that makes a lot of sense. Does using longer term floating rate debt make it harder to compete when in a very competitive acquisition market, given that
It does, because the other buyers are using short-term bridge debt and they're getting more leverage, meaning that they're producing a higher return, so they can offer a higher price and still get return, the same return for their investors as we would for ours. The difference being, though, is that they're taking on a lot more risk because now they're in at a higher price with higher leverage. And if things go wrong, they can lose all their money, whereas we'll be fine. So that's really the difference. And the argument between fixed and floating isn't as cut and dried as people would like to think. People think like, well, if rates are low, you lock them in. Why wouldn't you? And I do agree with that. If you're buying a single family home and you can get fixed rate, low interest debt, absolutely lock it in. I did. All the single family homes I own are on fixed rate debt, hands down. But in the commercial real estate space, fixed rate debt comes with prepayment penalties all of the time. There's really no way out of it. One way or another, they're going to get you. And the way that the prepayment penalties in most fixed rate debt works is a concept called yield maintenance, which basically says, if you take out a 10-year loan with us and you pay it off in 5 years, you still owe us the other 5 years of interest. Well, I mean, that's kind of the very basic way of putting it. That's essentially what the concept is. So that's very difficult if you're in your business plan is to buy it, renovate it, manage it better, and resell it in 5 years. You don't want to pay 10 years of interest on a 5-year business model. Floating rate debt doesn't come with that same prepayment penalty, which is where the advantage really lies. Now, the challenge comes when rates go up a lot quickly. When that happens, the fixed rate alternative right before it did that would have been the better choice, probably in most cases, if rates stay high for a long period of time. If they go back down, you're still screwed because you'll end up with that yield maintenance penalty. But if rates stay high, you could invest the proceeds into treasuries and be able to service that second 5 years off of the investments. So there are kind of ways to work around it if rates go high and stay high. But if rates are low and stay low, fixed rate debt is a killer.
Yeah, that makes a lot of sense. And I guess people love the higher leverage deals until they have to give the keys back.
Yeah, and, until they don't. Right. When they lose all their money, they don't like it so much anymore.
Absolutely. And I guess, as a theme from your book that, you obviously want to look for, you're here to build wealth. You want to create return. That's, part of the fun of investing, but that you always have to, the way you see deals is yes, but we want, like, the main priority is not losing our principal, not losing investor capital. I guess that theme makes a lot of sense. And, it seems like maybe people haven't had this practical way of thinking or pragmatic way of thinking recently. Maybe that's what scared you out. But I guess just to bring that in, curious to learn a little bit more about just the way your philosophy in that sense.
Yeah, I mean, you got to be practical. I mean, right. Our job as an investment manager is just risk mitigation, right? I mean, you can't make money for your investors if you're losing their money. So if you first have to survive in order to thrive, and if you over leverage and take on too much debt or have maturity exposure or take on too much risk, or you're buying really bad properties in really bad areas, especially with high leverage debt. Then you got the double whammy. It's just irresponsible. I mean, it's our job to preserve capital first, earn a return second. And we have to keep those priorities in mind.
Absolutely. And I guess I want to transition a little bit to start talking about the book. What was your motivation for writing The Hands-Off Investor? I guess I remember at the beginning you told a little story about someone who lost their life savings, which kind of encapsulates the fear around it. So I'm just curious if you could touch a little bit on your motivation.
Yeah, that was one of the motivations. There were two things that prompted me to write this book. One is that we get a lot of calls from investors asking about our investments. And when they call, they have a variety of different questions. So we've probably heard them all. And one thing I noticed was a lot of these investors, even though they're quote unquote accredited investors, which means that they should be qualified to invest in these kinds of passive investments, which, by the way, there's no test to become an accredited investor other than having $1 million net worth or 200,000 in income. These investors weren't asking the right questions. Sometimes they're asking questions that frankly were unimportant, or they were placing emphasis on questions that didn't matter as much as they really thought they did. And I recognize that one of the reasons for that was that there was no source of knowledge or no source of education on the topic of passive real estate investing to educate passive investors on what questions do matter and what questions you should ask. So that was one of my motivations. The other was that the story you just related, where a friend of mine lost her entire life savings by investing in a passive real estate syndication with the wrong sponsor. She didn't know what questions to ask, and maybe didn't even ask any, but she lost her entire life savings. And I felt like if I could write a book that would teach people how to invest in passive real estate syndications and prevent even one person from losing their entire life savings, then the whole exercise of writing this book would be worth it.
Mm-hmm. Yeah, it's powerful. I guess people think that it's all about the deals. Like, oh, I can get 18% return. That's much better than the stock market. But don't realize it's the sponsor that's the most important thing. I guess you touch on the 3 circles of trust. I thought that was an interesting way of kind of describing this idea. But you want to tell us a little bit about that?
Yeah. So the three trust circles are, it's a concept where if you're an investment sponsor, you need to know that your investors have fulfilled all 3 trust circles, or they're not going to make an investment with you. And basically what the first one is, they have to trust real estate. If assuming real estate is what you're raising money for, whatever you're raising money for, they have to trust that that is a viable investment, whether you're making widgets or investing in real estate or whatever it is you're doing. Let's just say, for the sake of discussion, you're trying to find investors to fund a real estate project. If your investors are like, oh, real estate's toxic, that's like catching a falling knife, it's just a big game, it's late night TV commercial, get rich quick junk, none of it makes any sense. If that's what they're thinking, they're not going to give you money, no matter how much they like you. They're not going to give you any money because they don't believe that real estate is a good place to put money. That's trust circle number 1. If they don't fulfill trust circle number 1, they're not giving you money. Hands down, period, end of story. Trust circle number 2 is they have to trust you. If they're like, gosh, I really like real estate, it's a great place to invest. But what the hell do you know about real estate? You've never done anything. You have no track record, never done a deal. I'm not investing with you. I'm going to go find somebody that knows what they're doing. So you haven't completed trust circle number 2. They're not going to give you any money. On the other hand, let's say they like real estate. They like you, and whether it's because you have a great track record, you've made a lot of money for people, you've shown them some really cool before and after pictures, or maybe they share DNA with you and they're related and they're like, hey, I gave birth to you, I'll give you money, or I've been your best friend since grammar school, I trust you, you're smart, I'll give you money. Whatever the reason that they trust you, they have to trust you. If they don't trust you, period, they're not going to invest with you. The third trust circle is they have to trust the deal. If they're like, love real estate, love you, you know what you're doing, but that property that you're buying is a total piece of junk. It's on the wrong side of town, at the worst corner in town. It's eaten by termites. There's nothing good about it. They're not going to write you that check. They have to trust that you're bringing a deal that makes sense. So the 3 trust circles have to be all completed. If any one of them is not complete, they will not invest. You got to get all 3. And so for the passive investor thinking about making an investment, those are the things they're thinking about. You need to be thinking about, is this a strategy for you? Is this the person to execute that strategy? And is that deal the right deal for you?
It makes a lot of sense. I know that, it makes a lot of sense that you'd want someone who has track record and has done it before, who has I guess, has been through some cycles and knows really how the industry works and knows how to protect capital. But there's also, at some point, everyone started in the industry. So I'm curious, how does someone start in the industry if they haven't done it yet? They don't have the track record yet. They're smart. They know about the industry, they understand things, but they just don't have some of these things that a lot of people look for. I guess what would your advice be in terms of starting?
Well, there's a lot of different ways that you can do this. I mean, everybody has to start somewhere. Nobody was born with 10 real estate deals under their belt and having produced a return for investors, right? We've all had to start from zero. Now, the way I did it was I just started small and grew over time. Now, I funded my first real estate investment because I found a seller that would carry the down payment and I could do the deal with no money down. Boom, there's a home run on the board, right? The next deal I did, I literally cash advanced every credit card I could apply for and get qualified to get. I cash advanced them all and used the money to buy another house, fix it up and resell it and repay that money back. Highly risky, by the way, not recommending that strategy, but that's what worked for me. Then the next one, I found somebody that would put up the money for the deal. If I, gave them an interest in it, and then I kind of did all the work, and then the next one, it was like, I got a private money loan, and then I got a signature line of credit from the bank, and kind of combined my own financing in a variety of ways, each time doing bigger deals and more deals. And that built a track record. And over a number of many, many years, I was able to get a large following of investors who have invested over, $300 million with me, somewhere, some big number like that. Now, you don't have to do that. I mean, you could go get a job. You could go to work for a real estate private equity firm as an analyst and kind of start on the ground floor and work your way up into their acquisitions department, and then maybe into asset management and kind of you get your feet wet that way, or a property management company or another syndication sponsor as doing anything, whatever that you sweeping floors. I mean, whatever it would be, you start somewhere and you build kind of knowledge of the industry. And as you kind of promote through the ranks, you start getting into a position high enough on the food chain where you can claim some of these deals as part of your track record. Another way is you could partner with another sponsor that has a lot of experience and track record and investors, and you could bring something to the table like, hey, I found a deal. I'll bring a deal to this group that has all this experience and kind of be part of the process. And then I can say like, hey, I've got this one deal under my belt. I brought this deal. So there's a lot of different ways. The important thing is you got to make sure that you can document this track record, whether, you got to take before and after pictures, keep a log of all the addresses, purchase price, sales price, how much profit you made, what returns you generated, because this is the exhibit that you're going to create to show people this track record to earn their trust, however it was that you developed it.
Yeah, well, that makes a lot of sense. There's a lot of, again, there's tons of different ways to start. So that's helpful. I wanted to bring up one piece of the book that I thought was really funny. You wrote a chapter about waterfalls. So I guess just a little bit more context about the book. It starts out in a way that, I guess you really teach people from the beginning, all the way to knowing advanced stuff. It's like if you just started in the middle and you didn't know anything about real estate, you'd be like, wow, like I don't understand how this works. But if you start at the beginning, it just seamlessly goes into these advanced topics, and you somehow already have this knowledge that you built up. So I'm really impressed with that part of the book. But somewhere later on in the book, you got to the section about waterfalls. I really liked how you started it. You talked about how you spend your whole day looking at these beautiful waterfalls, but they're really in Excel. But there's one question about waterfalls that I've been thinking about, and it's the fact that there's a difference between a return of capital and a return on capital. And I want to just see if you could tell us a little bit about that distinction, because there's a lot in the book. You mentioned there's a lot of different terms that are different in all these deals that if you don't read carefully, you could just not know what you're getting into. So I wanted to pick that one out to discuss.
Yeah, it's all about the order of distributions, right? So when real estate generates $1 of income, you're going to send that $1 of income to your investors. Now, how you categorize that dollar for the purposes of calculating the waterfalls is up to you as a sponsor, and it doesn't mean you get to make the decision as you're making the distribution. You make the decision as you're writing the operating agreement. And you're deciding, okay, when we distribute $1, what is that dollar? Is that dollar return on capital or return of capital? Which one is it? You make the decision. But what you have to do is you have to make sure that the mathematics in your Excel waterfall matches the definition that you've created. And the reason that it's important, for some people think like, oh, for tax purposes, you want this to be a distribution of capital because that's not taxed. Well, that's not true. You aren't taxed on your distributions, you're taxed on incomes. So that doesn't matter. They're two completely separate topics. From the perspective of distributions, the reason that it makes a difference is, generally speaking, you're going to find waterfalls have a concept called preferred return. And preferred return means, let's say I tell you, this has an 8% pref, so 8% preferred return. And then after that, it's a 50-50 split. Now, that's not a good waterfall, but just for the sake of simplicity, let's say that's the waterfall. 8% return, then a 50-50 split. So what that means is every dollar that I distribute, you get, the investor, you get the whole dollar. I get nothing. You get the whole dollar. I'm the sponsor. I get nothing. You get everything until you've been distributed an 8% return on your money. So you put in $100,000, you have to get $8,000. So until you've made $8,000 for the year, I get nothing as the sponsor. That's what an 8% preferred return is. Now, if the distribution says you get return on capital, then the 8,000 is deducted, or the dollar is deducted from the 8,000, right? You got 8,000 for the year you have to get your 8% on 100 grand. You got $1. That dollar comes off the 8,000. That's what that means. Now, next year, if another 8% will get added onto that. So if you only got 4% distributed the first year, and the second year you get 8%, you still get all of the 8%. And then in the third year, if you get 12%, you get all of the 12 because I still owe you 4 from the first year because you only got 4. So it's a cumulative. Now, where the distribution of capital matters, if you have it in that order, what that means is if I distribute $1, you no longer have 100,000 invested. You have 99,999 invested. So next year, the 8% is on the 99,999, not on the 100,000. So you actually get less preferred return accrual in subsequent years. So people think like, oh, return of capital is better because I get my money back first. But really, to the investor, it's actually less advantageous because it's reducing your unreturned capital balance, which reduces your preferred return allocations in future years. That's the distinction.
Mm-hmm. And so do you use return on capital in your deals typically?
Now, ours are return on capital. For us, return of capital only happens on capital events. It only happens when we do a refinance or a sale. That's the only time we categorize return of capital. Otherwise, it's always return on capital. And that's just us. I mean, not everybody does it that way.
Yeah, makes sense. I guess this is just a taste of the many different terms that, once you finish reading the book, you'll be caught up to figure out, what makes sense for your strategy. Because it's definitely, it all changes. It's not just real estate and stocks. It's like, there's real estate can look a lot more different ways than just stocks. I guess stocks have differences too, but yeah, I guess, I want to touch on some of the most important things that you think from your book that you want to make sure people listening take away.
Well, I think the most important one is, the old horse and jockey argument, right? Is it more important to look at the deal or the sponsor, or the real estate or the sponsor? And I've always been of the belief that the sponsor is most important. People oftentimes will ask me, how do I find a syndication deal to invest in? And I say, well, you start by asking the right question, because that question in and of itself is the wrong question. You don't want to ask, where can I find deals to invest in? Instead, what you want to ask is, where do I find sponsors to invest with? And that's an important distinction, because once you find the right sponsors to invest with, and that means you're spending all your focus on doing due diligence and research on potential investment partners. And once you've selected who's good and who's not good, then all you have to do is sit back and wait for them to present you with deals. And if you made the right choices and you picked good sponsors, they should only be showing you good deals to invest in, or they're not as good as you thought they were. So then you don't have to go find good deals to invest in. They'll come to you. So you need to find good sponsors to invest with. That's probably a key takeaway. That, and how you actually figure out which sponsor is good and which one's not.
Yep. And if you need the list of questions to ask, there's definitely recommend the hands-off investor. So that's I'm just imagining how many people in the world have bookmarks and just have it open in front of them while they're on investor calls and whatnot. So yeah, it's awesome. You ready for the lightning round?
Yeah, let's do it.
Awesome. So starting easy and getting harder. But some people think the first question's the hardest one, but what superpower would you want if you could have any superpower?
I think it might be the power to transport myself instantly. The ability to just snap my fingers and be in Hawaii and not have to drive to the airport, sit at the airport for 3 hours, get on a plane for 4 hours. To be able to just kind of teleport myself, I think would probably be the greatest superpower I could ever ask for.
Yeah, but you wouldn't get to, fly your planes.
Well, this is true. I wouldn't get to do that, but instead I'd be having fun on the beach, or walking a deal, or meeting with a potential investor. I could definitely enhance my productivity considerably.
Absolutely. Yeah, that's similar to mine. I want super speed for the same similar reasons. Also, I think it'd be fun. So what's your favorite book, or what's the one that's helped you the most?
Well, it's probably the one everybody recommends. Rich Dad, Poor Dad had a big influence on, my success and kind of the way I think about things. When I read that, 20 years ago, I think, really made a difference for me. It's one of my classic favorites. I also like another book called TED Talk. It's TED Talks. It's written by the head of the TED Talk organization. Really good book on delivering presentations and communicating your ideas, which in this business is really what it's all about. If you're looking to make presentations to investors to get them to invest with you, you have to be able to accurately convey your message. And it was a really interesting book on learning ways of conveying that message.
Yeah, that's interesting. I'll definitely check it out. I think the new question would be what's your favorite book besides Rich Dad Poor Dad? Because that's definitely the sweeping favorite. But
Yeah, you do need
reason.
to do that. Yeah.
So what motivates you to continue every day?
Just the fact that I love what I do and I couldn't imagine doing anything else. And this is fun for me. And I just I think when you love what you do, it's not like work, and I just enjoy doing it.
Absolutely. So what advice would you want to give to someone who wants to follow in your footsteps?
To just get started. I mean, there's the only way I got to where I am is by putting one foot in front of the other, setting a objective that I wanted to be a real estate investor, and what do I got to do to do it, and reading, learning, and then most importantly, getting out there and actually making offers on real estate, talking to sellers, and figuring out how to make that dream a reality.
Absolutely. So since I put you on the spot, I want to give you a chance for revenge. So what's one question you have for me?
I want to know, how is it that you could be so smart to make it through these university courses? Because I could not get myself up in the morning to do the college thing. And I have so much admiration for people who do. How do you do it?
Well, I think to me, I'm lucky because I have chosen classes that I find interesting. Like I really put my curiosity in the driver's seat as much as possible, where I get, like you said, it doesn't feel like a job or a burden when you're genuinely interested in it. Obviously, there's work that comes along that you rather not do sometimes, but genuinely feeling like I am becoming a better person, or I'm growing, I'm learning, my brain is filled with more useful things that I can then, continue to use to make a difference. And to the aspect of self-improvement is something I really love. I study philosophy, and to me, it's like, it's the ultimate question. How do I live a good life? And so when I'm reading about Aristotle, reading Plato, reading all these, smartest people to ever have lived, I feel like I'm learning how I will live a good life going forward. And to me, the fact that I'm answering the hardest question, or I'm working towards, or I guess it's never gonna find the final answer, but working towards this quest of trying to live a good life, and trying to understand what that means and how to do it, is really fulfilling. And part of me realized that living a good life is constant growth, constant learning, and that's kind of how when I feel motivated and I feel successful, is because I know I'm growing and I'm learning.
Wow, it's amazing how similar you and I are, because that's exactly, I think, part of what motivates me for real estate. I mean, every day is a learning experience. You never see the same thing twice. It's a fun business.
Absolutely. I think that's something that motivates me, or interests me about real estate too, that it's a lot of meet a lot of good people that could teach you a lot, but a lot of teamwork. But it's really just problem solving, like doing a really big, interesting puzzle, and trying to and learning how to do it, and integrating the changes in the world constantly. And so yeah, I definitely agree with that and feel that. And I think a lot of people who are successful in real estate have that curiosity and that drive to grow and learn, because if you're not learning, the market's moving on without you.
That thirst will serve you well.
Well, I'm glad, and I'm glad that that's one thing I don't have to cultivate, because I've gotten it. But I'm definitely looking to continue to grow my knowledge base and going forward. So appreciate you coming on the show. I learned a lot on this episode, as I'm sure everyone listening has as well. Is there any final remarks you wanna leave us with?
I think, my final remark is, be sure to check out the book, The Hands-Off Investor. If you're interested in investing in real estate, get out there and do it. If you're already investing in real estate, hopefully we'll cross paths one day, either as buyers or sellers in a transaction, or maybe as investors and sponsors in a transaction. Who knows? So I just say, get out there and go for it and go crush your goals.
Awesome. Well, I look forward to seeing you at the next conference that we're both at, and appreciate you coming on the show. Brian and everyone listening, keep making milestones. Before you go, I just wanted to say thanks again for tuning in to another awesome episode of Real Estate Milestones. If you've been enjoying the show and you'd like to offer your support, please leave a 5-star rating and review on Apple Podcasts. It's the best way to increase the show's visibility and help the message get out to a greater audience. I really appreciate your time and support, and keep making milestones.
The information provided on this podcast is intended to be educational and informational only, and is not considered to be formal legal advice. The listener should not take or refrain from taking action based on its content. Any listener in need of legal opinion upon which to rely in decision-making should consider formally engaging an attorney to review relevant facts in detail and examine the pertinent law as it applies to those facts.